Good morning, everyone. This is Shivam from MTM. Today, this is going to be an educational video, and I want to talk about something that I use extensively in my analysis, which is nothing but momentum cycles. So, in my experience, we often look at price and we try to understand the price by looking at it and judging whether the stock is trending, is it correcting, or is it, sideways and possibly getting ready for its next move. So, momentum is something that can help us answer those questions, but only if we're able to read it correctly. A common mistake which I think many people make, and even I made initially, is looking at momentum indicators merely as a buy sell indicator. You just get a bullish crossover and you take it as a buy signal, and you get a bearish crossover, you look at it as a sell signal. In my experience, that is not the best way to look at it or use it. What I prefer is to look at it in terms of a cycle. By cycles, what I mean is one leg or one move in the stock or the index is part of a one momentum cycle. So that's what my focus is going to be in this video. And we'll try to understand what a momentum cycle is, how momentum behaves differently in different market situations, and most importantly, how do we combine momentum cycles across different time frames. So let's start with first, what is a momentum cycle? Imagine this is a zero line. Now, those of you who have some basic knowledge about mathematics, you must be aware about what is a sine wave. So sine wave is something like this, which keeps moving around the zero line. Okay. Now in textbook, this looks very clean, but in real market, it's not the way momentum works. So some cycles can be large, some can be short. Just a second. So in real life, we can have a cycle which lasts so long like this, and then a small cycle like this, and this, and so on and so on. So in real time scenario, the cycles can be of different time durations. What matters is that each cycle starts below the zero line, comes back to it, and resets it, and keeps the market gets ready for next move. Now, if you draw one more line here as the average of that momentum indicator, now imagine this is something like MACD. Okay. Now you'll start looking at each signal as a buy sell, signal here, here, again here, and here. Now, not every signal is going to be a meaning of a fresh cycle. Some small signals like here can be part of the previous cycle itself. So I know the drawing is getting messy. Let's move to a live chart. So this is what I'm saying. You can see the indicator here at the bottom pane. I've given it a name, SG trend. So this is nothing but my own custom indicator that I've made. It's based on rate of change only. So nothing too special. The only thing is it moves around the zero line, which is nothing but this zero line here. So how we define each cycle is a move that starts from below the zero line, like here, and then completes one whole sine wave and comes back to zero line. So this is what I call one complete cycle. Now you'll see there were signals here as well, again here as well. So this portion I will not count as a fresh signal. I will not call it a fresh cycle, but continuation of the same cycle. So that distinction is extremely important, that what is a continuation and what is a fresh cycle. So if you see such kind of whipsaws that are part of one cycle only. So how do we differentiate between an ongoing cycle or a fresh cycle is by looking at whether the price is trending or the price is also breaking. So if a basic indicator like 20 period simple average can help you in that case. Right. So here during this whipsaw, the price remained above the 20 period average. So I will not call it a fresh cycle. Rather, I will call it one cycle itself. So next part is how momentum behavior changes in different markets. So in trending markets, you'll see that the cycles are extremely long lasting and there are multiple whipsaws, but the price does not break its trend easily. Okay. So I'm using the random stock Apple. You can use it on any given stock and try to understand the concept. So yeah, this is what I'm talking about. If you focus here, this phase, you can see so many whipsaws here. So if I were to give it importance to each buy and sell signal here, each bullish and bearish signal here and treat it as a trading signal, it would not make any sense. So in this case, I will start using 20-day average or something like a trend line along with my momentum signal. So if I just draw a trend line as well here. Okay. So now see, here the price was below zero, which means we are waiting for a fresh signal here. And we got a fresh signal and the momentum has moved above the zero line and the prices started to make higher highs and higher lows above the 20 period average as well as the trend line. Now till we see a convincing break of the 20 period average or the trend line, the same cycle is continuing. So if I just draw some vertical lines here and here, this completes one cycle, and you can see all this while the momentum has not come back to the zero line before it broke this 20-day average here. So before this big gap down move, one could have taken this break of 20 period average as the exit signal, right? So how do we differentiate between a um, clear whipsaw and actual trend changes by looking at it in terms of moving averages, 20 period average or a trend line, or whether the stock is breaking any higher high, higher low formation. So this is the behavior that we see in a trending market. Now let's try to find a phase where the stock or the market goes into a sideways kind of phase. This phase itself is a up down market. The stock was in this broad range. Now, the moment we enter a up down phase or basically a corrective phase for the stock, you can see that each signal gets more important. So you get a bullish signal here, you get a good tradable bounce, you get a bearish signal, again it sells off, again a bullish signal, again a rally, again a bearish signal, and again a sell off, again a bullish signal here, again a good rally, and then again we got a divergence before the sell signal starts working. But notice here 20 period average broke only here. Again the bearish cycle worked, and again, so basically each signal is working differently than it was in a trending market. So let me just remove the drawings. So in a trending market, I would not be looking at this each bearish crossover as a sell signal, but I would be trailing my view with an average or a trend line. But when we're able to judge that the behavior is according to a sideways phase, then we need to give more importance to the actual signal rather than the averages. A stock I pulled up to show a bearish example for the same. So this stock is in a strong downtrend. Now here you started getting whipsaws. But during this whipsaws, what you note is that the price is not able to close above the 20 period average. So this whole move is part of one cycle, and the cycle actually resets at this point. If I just mark it, yeah. So the cycle actually resets here, and we then again get a fresh sell signal. So I'll call this move a fresh cycle on the downside. So for all the people who use Elliott waves or any form of analysis that helps you differentiate between the legs, if you correlate each leg with each momentum cycle, it helps you differentiate between whether there is one move that is continuing or there is a fresh move that is starting. So if I get such kind of formation here where the price is consolidating but not moving above any key moving average, I would take it as some kind of continuation, be it a fourth wave triangle or something like that, rather than expecting a reversal here. So actual reversal is differentiated by the price itself when we start seeing a break of a higher high, higher low, or a lower high, lower low pattern, or any key moving average or a trend line. Let's move to the next aspect, which is the major focus for me, which is the multi-time frame cycles. So what do I mean by multi-time frame is that when we try to combine different time frames together and then see a signal on the lower time frame for execution, that actually helps. So a combination of two time frames is sufficient. For example, someone who trades on a longer run basis would try to combine monthly and weekly time frame. Someone who is trading on a shorter time frame would combine weekly and daily, and someone who's trading only for a couple of days would combine daily and hourly time frame. So what do I mean by that is, first on the higher time frame you focus what the signal is, where the stock or the index is, and then on the lower time frame you try to execute it using fresh signals. So for example, this is the same stock Accenture, and you can see these phases where the weekly momentum is in sell. Let's just mark it. I'll just use a vertical line. Okay. So now let's drop to daily. So during this phase, if we are to get a fresh sell signal on the daily chart, we will treat it as a bearish signal. So here we got one signal right here, and this whole cycle lasted uh, till about 24-25% drop in the stock price. Then again, from this point when the weekly momentum gave a sell signal, we wait for a fresh signal to execute on the daily chart, which occurred somewhere around here, and it resulted in a big move down. So that's how we have combined two time frames and tried to look at how that plays out. So to make things easier, now we have such an easy access to AI tools. We can simply code anything and get multi-time frame signals on the same chart. So how I look at it is, I just made this my own method to filter trades. Now it's nothing but I'll just remove the RSI condition. I put in that filter time frames as the 1 week time frame. So I basically given it a filter that when the momentum indicator is bearish on the weekly time frame, or the price is below the 10 period average on the larger time frame, coded as uh, the red background, and whether one of them is bullish, then just give me a green background. So I within that background, I know which signal I need to give more importance to on the lower time frame. So now this color coding that I've got is based on the larger time frame, that is the weekly time frame. And during those phases, if I'm getting any fresh signals on the lower time frame, I will give it more importance than the signals that I'm getting in a opposite direction. So that visually helps. So you can see that whenever the weekly chart is weak, it's coding it in a red color, and during those phases, we are getting fresh bearish crossovers that are making more sense. So let's go back to some bullish chart like Apple again. Yeah. So you can see this long phase here where the weekly momentum indicators were bullish, during which we have got multiple fresh signals on the daily chart, and each time it has given a new cycle. So how I look at it in terms of multi time frame is, for example, if my larger time frame is bullish, the thought process is buy, then exit or trail my view, wait for momentum to fall back to zero, again look for a bullish opportunity. If the higher time frame is bearish, then short, then exit when you're in a good profit, or trail your view with some moving average, and then once you're out of the trade, again wait for the momentum to reset to the zero line, and then again look for a short opportunity. So just don't trade against the higher time frame. That's what the approach works better and tries to avoid unnecessary trades and improves the strike rate as well. So let's go to something like gold or silver. See the beauty of momentum on the gold chart. Somewhere here in September of 2023, we started a fresh bullish cycle. And since then, the momentum never came back to zero line. Okay. All this while it was above zero. The moving average, or that is the 20-week average, never broke. The price was above it. So I will call this entire thing as one cycle. So if I had to make a sine wave here, this entire move is one cycle. Okay. Which finally ended here with the break of 20-week average. Right. So let's go to the daily chart now. Now, once the average got broken, and we know that a long 2-year long kind of cycle has ended. Now here each sell signal from above the zero line, each bearish crossover will be looked at as a fresh cycle. So here during this phase, we got one signal here, one signal here. Again, this whole while one signal is continuing. Why? Because again, the price is not able to move above the 20 period average. So it's able to give us few down cycles here like this. So that's how multi-time frame analysis work along with momentum cycles. So how do you actually know whether a larger cycle is ending? There is no single perfect answer. First, momentum itself starts to weaken. You might see some divergences. You might see repeated failures for the momentum to make new highs. But once again, we would come back to the price for that signal. For example, I extensively use 20-day average along with the momentum indicator to get a signal. The first meaningful break will tell us something is changing. For example, here on gold, I put out an update a couple of days back only because it was able to sustain above the 20-day average for the first time after 12th May. Okay. So someone with a larger holding period may use 40 or a 50-day kind of average. Then again, coming back to the basics, that is trend lines, channels, or Dow theory, which by which the price itself confirms that something is changing. Momentum tells us about the internal strength of the move, and price tells us whether the trend is actually still intact. So, the three things to take away from today's video: first is the momentum moves in cycles. Don't treat every crossover or every small reversal as an independent buy or sell signal. Second, understand the market environment. Momentum behaves differently in a very strong trend and in a sideways market. So in a sideways up down market, each signal may have more importance, but in a trending market, the cycle might not end till we actually break any key tool like an average or a trend line. And the third, which is most important in my opinion, is the multi-time frame analysis. So once we do our analysis on a larger time frame and judge whether where we are in the larger market cycle, and then we start going to the lower time frame and try to execute that view. So someone with an even larger view would want to use monthly and weekly time frames. So if I just have to show that on gold, let's use gold itself. So on gold, a new cycle started back in 2023. Now once we have judged that a new monthly cycle has started, which is going to last for a long time, one can drill down to the weekly chart and now try to look at each move at one cycle. Now in this case, the first cycle lasted till here. Then now during this phase, the momentum was not able to pull back to zero. Why? Because the price never broke 20 period average. So I would look at it at one cycle, right? But if we go back to this phase on gold, here you were getting complete cycles. So each time it came back to the zero line, a fresh move started, like this one. Again, from this point is somewhere from here, like this. So each move that starts from the zero, below the zero line, and comes back to zero line is one cycle. Let the higher time frame tell you the direction of the larger trend, then use the lower time frame momentum cycle to look for better opportunities in that direction. Goal is not to have a magic indicator that predicts every market move, but to understand where you are in the larger market cycle and then build a process around it. Once you start looking at the market this way, momentum becomes much more than just an overbought or oversold indicator. It becomes the rhythm of the market that you understand. So once you miss a move, you have a discipline to wait for it to fall back to zero line and then enter on the next cycle. So when you enter something when it's already extended or in the middle of some move, the risk reward is not in your favor and the chances of going wrong are more. So it's the discipline to wait for a fresh cycle helps. So if you use it on any stock, you'll see that the discipline helps. Let's go to some stocks here. Let's say you missed the entry here. And now rather than entering any on a random basis, you simply wait for the momentum to fall back to zero line and then enter when a new cycle starts here. It gives you much better opportunity and the better probability of going right. So that's it. I hope you made sense of this. And when I talk about cycles more in my charts, you'll be able to make more sense of it in terms of what I'm trying to communicate. So if you have any questions, drop down below in comments and I'll try to take it up.